January just reset the Inland Empire housing market, and most people are completely misreading what's actually happening. Now, prices dipped and sales slowed. Days on market jumped, and yet pending sales surged nearly 9%. So which is it? Is the market cooling, or is demand quietly building under the surface? Today we're breaking down the official January 2026 Inland Valley Association of Realtors housing report, layering mortgage rate data from Freddie Mac, Treasury bond yields from Federal Reserve H.15 data, oil prices, and economic insight from Mortgage Market Guide, because 2026 isn't about fear, it's about positioning. I'm John Abril, realtor and mortgage broker here in Rancho, Cucamonga, and on this channel at the Realtor Broker, we break down the Inland Empire market with real numbers, real sources, and real strategy. So if you want housing clarity without media spin, hit subscribe, and let's start with the data. So January 2026, straight from IVAR, Inland Valley Association of Realtors. According to the official January 2026 Inland Empire monthly summary report, median sales price was $615,430, down 1.5% year over year. Sales volume was $1.154 billion, down 5.5%. Sold listings 1,738, down 3.9%. These numbers come directly from the Inland Valley Association of Realtors January 2026 report, not speculation. Now here's what changes the narrative. Pending sales 2,344, up 8.7% year over year. And that means that contracts signed in January rose nearly 9%. Pending sales are future closings. That's demand forming. That's pipeline activity. This is not what a collapsing market looks like, not at all. Now, days on market increased from 28 days in January of 2025 to 34 days in January of 2026. That's a 21.4% jump year over year. Now, cumulative days on the market rose 32 days to 37 days. Now, what does that mean? In January 2021, buyers had hours. In 2026, buyers have weeks. And when time expands, leverage shifts. Now, what I'm seeing here, more seller credits, more rate buydowns, and more repair negotiations. Now, this isn't weakness, it's balance returning. Now, let's zoom in on these individual cities. Let's start with Rancho Cucamonga. Median price, $790,000, up 3% year over year, 30 days on the market. Rancho remains stable and competitive. Claremont, the median price, $930,000, up 8% year over year, just 12 days on the market. Claremont is tight, inventory is limited, and demand strong as always. Ontario, median price $620,000, down 8% year over year with 32 days on the market. Ontario is recalibrating faster. Upland's median price $681,000, down 12% year over year with 37 days on the market. Upland shows pricing pressure, but homes are still selling in just over a month. These numbers are directly from the January 2026 City Overview section of the Inland Empire Housing Report. And this is why hyperlocal matters. Sell price versus list price. Homes are selling at 98.67% of the original list price, and that means buyers are negotiating, but sellers are still capturing nearly full value. We are not seeing distressed pricing, we're seeing normalization. January's financing breakdown, here you go. 48% conventional, 21% FHA, 16% cash, and 15% other. Now, why does that matter? Because if cash dominated, that signals investor takeover. If FHA disappeared, that signals affordability collapse. Neither is happening. This market is broad-based. Now let's talk about rates. And I want you to understand where this information is coming from. According to Freddie Mac's Primary Mortgage Market Survey, PMMS, for the week ending February 12, 2026, 30-year fixed mortgage rate was 6.09%, which is down from 6.11% the prior week, down from 6.87 1 year ago. Freddie Mac's PMMS is a national weekly survey of lenders across the country. When major news outlets quote mortgage rates, they reference Freddie Mac. So when I say 6.09%, that's institutional data, not an opinion. Now, Let's go in a little bit deeper. The 10-year US Treasury yield is currently around 4.1%, down from roughly the mid 4.6% range a year ago. Now that data comes from Treasury H.15, which is a Federal Reserve published bond data. Sites like YCharts simply display the official Fed data in a clean format. Mortgage rates follow the 10-year Treasury directionally. When bond yields fall, mortgage rates tend to improve. When bond yields rise, mortgage rates move higher. The 10-year has recently slipped below the 4.2% area after trading above it earlier this year. If it can drift closer to that 4%, that could support modest rate improvement, but that's not a guarantee. That's just very much a technical observation. Oil has been drifting higher, with US crude trading in the low to mid 60s per barrel and Brent in the high 60s as of mid-February. Now, that pricing is tracked through the Federal Reserve economic data like FRED. Now, why does oil matter? Because higher oil raises transportation costs, raises manufacturing costs, feeds inflation expectations. Now, inflation expectations influence bond yields. Bond yields influence mortgage rates. Energy doesn't just affect the gas at the pump, it affects housing affordability. Mortgage Market Guide recently highlighted that the latest jobs report came in stronger than expected overall. Unemployment remains in the low 4% range. Wage growth is definitely firm. Markets interpreted that as economic resilience. At the same time, retail sales data has shown softness, suggesting that consumers may be cautious. Consumer spending drives roughly 70% of the US economy. So we have a push and a pull. Stronger labor is upward rate pressure. Soft spending is downward rate pressure. That balance is helping keep the mortgage rates in the low 6% range instead of spiking back towards 7%, and stability supports housing demand. Now let's connect everything. We have the median price $615,430, pending sales up 8.7%, days on market 34, sales price to list price 98.67%, mortgage rates at 6.09%, 10-year yield at 4.1%, all sourced, all verifiable. And this does not describe any kind of a crash. It describes recalibration, and recalibration creates opportunity. So if you're buying in 2026, look at homes sitting 30 plus days, negotiate credits, ask for rate buy downs, and Ontario and Upland are offering flexibility. Rancho and Claremont require sharper offers. This is a thinking market, not a frenzy market. If you're selling, price off of January 2026 close comparables, not 2022 peak prices. The first 14 days on the market determine your outcome. Overprice and you're going to chase reductions. Price right and you'll negotiate confidently. So January 2026 shows stability, not collapse. Balance, not panic. Momentum quietly building through pending contracts. And mortgage rates hovering in the range that keeps buyers engaged. And strategic windows don't last forever. If you live in Rancho, Cucamonga, Ontario, Upland, Claremont, or anywhere in the Inland Empire and want a personalized breakdown, comment your city below. If this helped you understand what is actually happening in January, hit like. And if you want housing and mortgage updates sourced from Freddie Mac, the Federal Reserve, and the Inland Valley Association of Realtors data, subscribe to The Realtor Broker, because clarity does win. And in 2026, clarity belongs to the informed. Thank you for watching, and remember to subscribe and turn on those notifications and share this with someone who might benefit from the information.